Welcome to CoreLogic RP Data's update on housing market conditions for October 2015, brought to you on behalf of Credit Union SA. With the Australian housing market moving into the spring season, we can report that conditions remain varied across the capital cities over the month of September. At a broad level, capital city dwelling values rose by a healthy 0.9% over the first month of spring. The latest result takes capital city dwelling values 4% higher over the September quarter and 11% higher over the past 12 months. The headline growth rate was pushed higher by a very strong performance across the Melbourne housing market, where dwelling values rose by 2.4% over the month and were 7.4% higher over the quarter. We may be seeing a changing of the guards here, with Melbourne overtaking Sydney as the best performing housing market. September marks the third rolling quarter where Melbourne has shown a stronger growth rate than Sydney. Sydney dwelling values were up by a still very healthy 4.6% over the September quarter, but flat over the month. Other housing market indicators are also pointing to a potential slowdown in the Sydney housing market. Clearance rates have shifted from the high 70% range to the low 70% range over recent months, and Melbourne's recently started to record a stronger rate of auction clearances than Sydney. Although clearance rates have eased, it's important to note that even at the 70% mark, the auction results across a substantially higher volume still indicate fairly strong housing market demand and suggest there's likely to be further growth in home values. Listing numbers are rising rapidly as well, which is normal for the spring season. However, the number of newly advertised properties in Sydney is now 16% higher than a year ago, and the total number of listings has moved to be about 5% higher than at the same time last year. The only other capital cities where total listing numbers are higher than a year ago are Perth and Darwin, where market conditions have been softening since early this year. Higher listing numbers are a great outcome for buyers, which means more choice and less urgency in their decision making. Although new listing numbers are rising, vendors in Sydney and Melbourne are still experiencing a rapid rate of sale. The typical Sydney home sells after just 26 days, and the typical Melbourne home is selling after just 32 days. With lots of new homes becoming available for sale, it'll be interesting to see whether the average days on market figure starts to rise. Across the other capital cities, the average days on market is recorded at 50 days in Brisbane and Adelaide, 67 days in Perth, 65 days in Hobart, 73 days in Darwin and 49 days in Canberra. Detached house values have continued to rise at a faster pace than unit values over the past year in all capital cities except for Hobart. Across the combined capital cities, house values have increased by 11.6% compared to a 7.3% rise in unit values. The disparity between the performance of houses and apartments is most significant in Melbourne, where house values are 15.6% higher over the past 12 months, while unit values are up by a much lower 3.7%. The slower growth conditions in the apartment sector are most likely attributable to the higher supply levels being experienced across many cities for this product type, as well as the escalation in value for the underlying land component of detached houses. Home values in Adelaide have fallen by 1.6% over the 3 months to September and are 0.3% lower over the past 12 months. Like most capital cities, detached housing markets have outperformed the unit market over the past year, with house values rising by 0.3% and unit values falling by a substantial 6.9%. Over the past year, house rents have increased by just 0.1% and unit rents have fallen by 0.2%. As a result, yields are unchanged over the past year at 4.2% for houses, while unit yields have firmed at 4.7% to 5.0%. The capital city housing markets remain extremely diverse. Home values have recorded strong growth over the past year in Sydney and Melbourne, moderate growth in Brisbane and Canberra, while values have fallen across the remaining 4 capital cities. Outside of the capital cities, regional markets linked to the resources sector are generally seeing some value and transaction falls. On the other hand, coastal and lifestyle markets are bouncing back, with values and buyer demand generally lifting. The diversity in the housing market highlights the different growth drivers that are evident from region to region. The economies of Sydney and Melbourne are relatively sheltered from the downturn in the resources sector, and they're benefiting from a very healthy services sector and positive population inflows, while the mining states and territories are experiencing softer economic conditions and a sharp wind down in population growth. Looking at mortgage demand, the annual expansion in investor-related housing credit has continued at a pace that's higher than the APRA's mandated 10% growth per annum. However, the August figures from the Reserve Bank showed that credit for investment housing has increased by 10.7% over the year. That's down from a recent peak of 11.1% in June. With many banks now placing a premium on investment mortgage interest rates and also increasing serviceability limits on all mortgages, we may be starting to see mounting evidence of a cooling in investment housing demand. While investor demand appears to be slowing, credit growth to owner-occupiers appears to be rising as many banks switch their focus to this segment of the market. The cumulative effect of tighter lending conditions, more expensive mortgage rates for investors, and lower yields, as well as natural affordability constraints and higher levels of new housing supply, is likely to continue to dampen some of the more exuberant market conditions we've seen across the Sydney housing market. It should eventually begin to have a similar impact on housing demand in Melbourne. However, there's little sign of this occurring as yet. Listing numbers are already showing their seasonal spring climb, which will provide a timely test for the housing market's strength through spring. Furthermore, auction clearance rates have been trending lower in Sydney and Melbourne over the past couple of months, potentially highlighting a moderation in the rate of value growth in these cities. Although we anticipate that value growth will continue, we do expect that in Sydney's case, the rate of growth is already starting to slow down. While we may be moving through the peak of the growth cycle, we need to remember that the housing market conditions are as diverse as they've ever been. Each city is at a different stage of the market cycle, and the sub-markets and the micro-markets of each region show an even greater range of performances. If you'd like to dig deeper to analyse housing market conditions in your own neck of the woods, check out our consumer website at www.propertyvalue.com.au or our corporate website at corelogic.com.au.